The biggest wealth-building opportunities in the market are not in some secret stock. They're right in front of us, being overlooked for all the wrong reasons. When lawsuits hit the news, when regulations threaten, or when quarterly earnings are missed by pennies, Wall Street overreacts. Analysts issue downgrades, institutions trim positions, and retail investors panic sell at exactly the wrong moment. And guess what? 2025 is creating the perfect storm for these overreactions with 5 stocks. These 5 companies are being hammered by temporary headwinds that have nothing to do with their long-term potential. The market has completely misunderstood what these businesses are capable of. Today, I'm going to show you exactly what these 5 stocks are, why each one of these stocks is misunderstood, and why they will silence every critic by 2026. Hello, I'm Andrew. Without any further ado, let's get started. First up is Google. Google owns 75% of the internet search market and 85% of the mobile search market. This isn't just dominance. This is a monopoly that prints money. But the stock is trading at a P/E ratio of just 21. That's absurd. That's the P/E ratio of a boring value stock, not a tech giant with a $2 trillion market cap. So why does Wall Street hate this stock right now more than they hate their ex-wife who ran off with their gym buddy? It's down over 10% just in the last month because of 2 major reasons. First, the Justice Department wants to break up Alphabet and force them to divest Chrome and Android. Let me translate. The government is afraid of how powerful Google has become. Investors are dumping shares in panic over these regulatory headlines, creating mass selling pressure. Second, everyone thinks ChatGPT is going to destroy Google's search business. Give me a break. While everyone's fixated on these threats, they're completely overlooking the cash-generating machine underneath. Even if Google has to pay billions in fines or divest some assets, the core business will keep pumping out cash. And on the AI front, Google has unlimited resources to compete. They're already rolling out features like Vision Match. They're not sitting still. This disconnect between Google's fundamental strength and Wall Street's panic is creating the buying opportunity of the decade. 5 years from now, investors will look back at this moment and kick themselves for being scared away by headlines instead of focusing on the fundamentals. The biggest returns come from buying quality companies when everyone hates them, and right now, Google is at the top of that list. Next up is Palantir. This company is building the nervous system for AI implementation across government and enterprise. Half of their business comes from government contracts, which means stable, recurring revenue that doesn't disappear during recessions. The other half serves businesses from Fortune 500s down to mid-sized companies, giving them the tools to actually make AI useful instead of theoretical. In just the past quarter, companies announced more than $325 billion in AI investments for 2025 alone. Apple is throwing $500 billion at AI over the next 4 years. A massive portion of the spending will go towards software platforms that can implement AI in the real world, exactly what Palantir does. So why does Wall Street hate Palantir with such passion? One number, 450. That's the P/E ratio. Wall Street analysts are having absolute fits over this valuation, calling it completely detached from reality and absurdly overpriced. The stock is down almost 10% in a single day as these valuation concerns spook investors out of their positions. But here's what these critics are missing. Palantir isn't just another software company. It's the bridge between theoretical AI and actual business implementation. The company that helps businesses actually use AI to make decisions and generate revenue will capture a massive portion of this multi-trillion-dollar shift. The P/E ratio looks high today because we're at the beginning of the adoption curve. This disconnect creates an extraordinary opportunity. When everyone's fixated on today's valuation metrics, they miss the exponential growth curve ahead. This is like looking at nvidia's P/E ratio in 2016 and deciding to pass because it seemed overvalued, a decision that would have cost you a 2,500% return as they became the backbone of the AI revolution. Before I reveal my stock number 3, Share this video with someone who needs to hear about this massive buying opportunity. And consider subscribing to the channel for more such profitable investment ideas that most investors are not aware of. All right, stock number 3 is SoFi. This might be the most misunderstood stock on this entire list. Before I tell you why, let me open with something that shocked me when I discovered it. SoFi has grown from 3.4 million members to over 10 million since going public in 2021. That's a 194% increase in just a few years. And yet the stock is down 12% year to date. Make it make sense. The market is completely missing what's happening here. SoFi isn't just another digital bank. It's the financial super app for an entire generation. Think about this. They get young customers with student loans, then offer them mortgages, investment accounts, insurance, and everything else they'll need financially for the next 40-plus years. So why the disconnect? Wall Street hates this stock for the most short-sighted reason imaginable. It's too small, they say. Only 1% of Bank of America's deposit base. They're comparing wine to vinegar. This is like dismissing Visa in the early 1970s because it was tiny compared to established banks. Completely missing that they were building a payment network that would eventually process trillions in transactions. But here's where it gets really interesting. And I'll get into this more after we look at the next 2 stocks on my list. The lifetime value of SoFi's young, tech-savvy customers is extraordinary. When traditional banks are spending hundreds of dollars to acquire new customers, SoFi is building a captive ecosystem that competitors can't touch. Remember this point when we circle back, because it ties directly into why SoFi could deliver returns that make today's tech darlings look pedestrian. But first, let's look at our next misunderstood giant that Wall Street is completely sleeping on. Microsoft, the wolf in sheep's clothing. Here's a question that separates amateur investors from the pros. What's the biggest AI company in the world? Most people would say NVIDIA. Others might say Google. But they would never think of Microsoft. That's because Microsoft's still in our minds, is that boring Windows and Office company from the 90s. You see, Microsoft isn't just dabbling in AI, they're completely reinventing themselves around it. While everyone was distracted by ChatGPT, Microsoft quietly integrated this technology across their entire ecosystem. Their early investment in OpenAI was pure genius. Windows, Office, Azure, Xbox, everything is becoming AI enhanced. Azure, their cloud business, grew 31% last quarter while integrating over 1,500 AI features across their products. They've already deployed Copilot AI to over 60% of Fortune 500 companies. With an extra $30 per user monthly premium that's barely factored into analyst models. Microsoft is projecting AI-driven revenue to hit $10 billion by next year, and that's their conservative estimate. They're literally changing how 1 billion people work every day, and Wall Street is still valuing them like a legacy software company. Oh, it's already a $3 trillion company, they say. How much bigger can it get? The stock trades at a P/E ratio of 32. That's practically value stock territory for a company transforming this rapidly. The market is making a catastrophic error here. I guarantee you'll see this disconnect resolve in the next 24 months as Microsoft's Copilot starts driving revenue beyond anything analysts are modeling today. When that happens, the 30% discount we're seeing now will be long gone. Last on our list is Berkshire Hathaway. It might seem strange to include Warren Buffett's company on a list of hated stocks, but hear me out. Sometimes a market's indifference creates the same opportunity as outright hatred. Berkshire is a massive holding company with significant stakes in Apple, Bank of America, American Express, and dozens of wholly owned businesses. It's sitting on a cash pile of over $150 billion. It's outperformed the S&P 500 by 9.45% over the past year, and by an astonishing 352% over the past 2 decades. The current price has a P/E ratio of just 10, practically value stock territory. So why is the market so lukewarm on Berkshire? 2 big concerns. First, Warren Buffett is in his mid-90s, and everyone's worried about succession. What happens when Warren's gone is a constant refrain. Second, in a market obsessed with AI, crypto, and high-growth tech, Berkshire's methodical value approach feels outdated to many investors. But here's what these concerns miss. Buffett has spent the last decade carefully preparing his succession plan and teaching his investment philosophy to the team that will take over. The company's structure and culture will outlast any single leader, even one as legendary as Buffett. More importantly, in a market that increasingly volatile and driven by speculation, Berkshire's disciplined approach and massive cash position represent exactly the stability most portfolios desperately need. While everyone chases the newest AI stock, Buffett is patiently waiting to deploy capital when true value appears. This creates the perfect contrarian opportunity. Most investors are ignoring Berkshire while chasing higher returns in riskier assets. But with markets facing uncertainties from new tariffs, trade wars, and inflation concerns, Berkshire's combination of stability, value, and dry powder positions it perfectly for what's coming. Now, remember when I told you SoFi was being dismissed for having only 1% of Bank of America's deposit base? Here's what Wall Street is completely missing. SoFi isn't playing the same game as traditional banks. They're acquiring customers at $250 to $300 each, while big banks spend $1,500 to $2,000 per customer. And SoFi customers bring in 3.9 products per user compared to the industry average of 2.1. The math is staggering. SoFi's average customer lifetime value is projected to be 4 to 5x higher than traditional banks, yet they're valued as if they're just another struggling fintech. Their unit economics are more like early PayPal than a regional bank. When they cross 15 million users next year with accelerating cross-selling metrics, the market will finally wake up to what they've built. This isn't just growth. It's efficient, profitable growth with compound network effects. The only question is whether you'll recognize it before the institutional money piles in and drives the price beyond reach. And that's the common thread with all 5 of these hated stocks. The market is missing what matters. By the time these headwinds clear, the biggest gains will already be gone. So there you have it, the 5 most hated stocks that are on a massive sale right now. Hope you liked this video. If yes, consider watching my videos on other topics like ETFs and dividends as well. I'll see you there.